The numbers this month are wild. Record high inventory, record low demand. Cape Coral has just made the number 1, number 3, and number 15 in the country on certain data points, which are not good. Builders are sitting on huge amounts of inventory, and buyer traffic has stalled out. And even though mortgage applications have ticked up, pending sales just aren't following. You add in $1.3 trillion in credit card debt with a over 12% delinquency rate, and it's no wonder affordability has hit a wall. In this video, I'm going to break down the current supply, demand, pricing, and stabilization trends, plus what they mean to buyers, sellers, and investors heading into 2026. And I'll give you tips to navigate this market before it shifts again. Stick around, you don't want to miss these data points. Let's get right to it. First, we start with supply. And I have said this for every single month for the last couple of years, as well as even previously when I was doing these back in 2002 and 2016. We have a season. The inventory goes up, it goes down, it goes up, it goes down, and every peak is always March, April, and every valley is September. And look what happened. We hit our peak in April, March and April, and we hit our valley last month, and we just had an uptick back up. We went from 10,200 to 10,800. Increased inventory, very predictable. We actually predicted this last month and said, let's see if this happens. This did stop the trend of 6 consecutive drops that you can see in this graph here. So more inventory means more choices for buyers and better for buyers out there. Our inventory is still 12% higher than last year, October. Single family homes are 65%, condos 21%, and the rest are townhomes and villas. On all of this inventory, we still have over 2,000 existing homes that are new construction that still have not sold. That's a 4% increase. Thought the builders were giving away homes. Think again, because we gained inventory of builders. This is a trend that we are seeing, but I'm going to be going rapid fire through these because I have a lot of data points to go over. I don't want to make this a half an hour long, but inventory going back up for buyers out there. That's more choices, more competition, lower prices. So we did have quite a few homes disappear last month, and I have been keeping track of the withdrawns, expireds, and terminated and graphing it out, as you can see here. Eventually graphs do come and go. I do 50 graphs for every PowerPoint update, and then I kind of pick the ones that are talking about the current month. But we still have 1,400 homes disappear from the market, either withdrawn, expired, and terminated. But what was funny is 245 of them were new constructions, but only 6 were the national builders, your Pulte's, your D.R. Hortons, your Lennars. That means the majority of these are what? They're new constructions built by investors. All those investors who bought land in 2023, build it and they will buy. They built it and now they're sitting and rotting. And we're starting to see short sale new construction, which we haven't seen since 2008. So it means builders are just giving up. I actually saw one just this last week. The investor hasn't paid the taxes in 2 years. He has no money. He's trying to break even and he can't. So even though we lost 1,400 homes to withdrawn, terminated, and expired listings, people just giving up or taking themselves off the market, we still had a net increase of 600 to 700 homes. So that is something that was interesting. Demand is kind of staying in this downward trend here. You can see I circled the peaks of the market. You know, when we have the highest demand, March and April, when the demand is kind of reaching its peak, this is when the demand pick up, and that's why our inventory goes down. And you can see here, since COVID, every high has been lower, lower, lower. I drew these little channel here, and every low has been lower and lower and lower yet. But this year, January, we hit the lowest sales in 40 years. And February, that was the lowest February sales in 40 years, the lowest March, April, May, June, July, August, September. But this month, we actually did not hit the lowest in 40 years. So it was not as bad as last year's sales, which were like in the 700s. We actually sold 891 homes, which is good, but still staying within this channel. Expect this next low to probably keep on going down. It's going to go up and down, but I do not see it breaking this mold until we see this graph going above my trend line. Of the 891 sales in October, we had an increase of 5%. That was good. 263 were new construction, so that's down from the previous month of new constructions, and they are suffering right now. It's also not our season either. So this is when inventory builds and demand goes down normally and historically, and it looks like we're keeping that trend. The median home price actually went up again, but this is very deceiving. It does go up and down and up and down. But what I did was, with this orange graph, I took in the average household income, the interest rates at the time, the prices of the homes, and I kind of calculated what the home price should be based on income, interest rates, insurance, and taxes. And you can see here, it's a nice line. And in 2016, we hit that channel, and it was nice and steady, and it didn't really exceed above and beyond that until COVID, and then we had this boom. Call it a bubble. If that was a bubble, what is this? You can see the downward trend, though, as prices are very, very stubborn this time around. We had a $6.9 million home on Bonita Beach, and I'll explain why it goes up and down and it looks a little staggered. Is because when you sell a third of what you're normally selling, each sale matters more. And if you have a 6.9 million and you have 58 homes that sold over $1 million, it changes the median house price. Is that the normal house? No. But I do want to keep this graph going. I've been doing it since 2000, just to kind of say, where should we be? About 265, 970. That would be based on what the house price should be. But as you can see, when it does overcorrect, it does overcorrect on the downtrend until it gets back on track again. And we definitely are staying within this trend line that I drew. But average median home price is 360. Kind of keep that for what it is, and we're kind of look at the trends of this graph so we can understand what's going to happen in the future. The reason affordability graph, this is my favorite graph. There's two graphs that can tell you everything you need to know about the real estate market. This affordability takes the average household income of the county, which is given by the Census Bureau, which is $84,864. It increased 0.1%. What would he do? Everybody's making $120 more a year, $10 more a month. It did bring the affordability down. We did have interest rates go down as well, even though the Feds dropped a significant amount, and they just dropped at the end of this month as well. Interest rates every time, we saw this last month's PowerPoint, every time they drop the rate, the Fed rate, the interest rates go up. Guess what happened? Yesterday they dropped the Fed rate, and today the interest rates went up. It's already built in. Based on just this $84,000 household income, that means the average household can afford $1,909 if we take this long-term average. But is this reality? Can people afford 27% of their gross income to go to a mortgage? No, because ever since 2008, it has kind of stayed in this target zone. Briefly dipped when we had the really low prices due to foreclosures, and it dipped again when they brought the interest rates down to 2%. But then we exceeded that in this latest bubble. We're still over 30%. We're nowhere near the long-term average, but in my opinion, this is where it needs to be. What sounds more realistic? The average person in Lee County affording $2,100 for a mortgage, or $1,626? Most of you probably agree $1,626. Much more affordable, and that's what it should be, but it's not due to interest rates, taxes, insurance, and the pricing. So where do we have to go? Hey, we're on the right trend. This is a good trend to have. We need this to come down. I want to see it break at least the long-term average and make its way towards this target zone. And how is it going to do that? It's not all interest rates. It's not all about pricing. It's all about all four things together: principal, interest, taxes, insurance. But either way, we're too expensive. We're not affordable. The stabilization is the Zillow Home Value Index, and I got a different graph to show you as well, but I just want you to take a look at this. What this is saying is, on a month-by-month basis, did the house go up or down? If it's at this zero line, that means it didn't do anything that month, and as you can see, sometimes it goes up 3% a month. That's 36% a year. Look at this double hit that we had during COVID, where it went up over 3%, almost 3.5% in 1 month. And then what it do? It's on its correcting back down again. Last time we crossed this line, it took 59 consecutive months for us to touch the line, find support, and then bounce off of it, which is where I have that arrow right there, which is 2012. The last months we've had, you can see I highlighted the 1.28% per month, that we were getting further and further from the line, couple little upticks up, then right back down again. And you can see we have a couple months of upticking up. So we're still losing 0.93% a month. It's positive that we're getting close to the stabilization line, but let's wait to call this market stabilized when we actually don't lose or gain any money on a house. So right now we're at 27 consecutive months of negative home value, and if you go into my YouTubes and look at all my updates, I remember when this was negative 0.1. But you can see here, it did kind of peak out that negative 1.28, and then it's kind of getting closer to zero, which is a positive thing, but are we stable yet? Nope, because it hasn't hit this line and shown support. So let's compare month to month here from October 1st to November 1st. Housing, we have more inventory, 5% increase. The solds went up 5%. That's pretty good. Still really low compared to our average 1,700 homes that we sell a year, a month. But still, I'll take increased sales. The pendings kind of stayed the same, but an uptick of 3%. Pending sales tell you how many homes are going to close next month. So if 16 homes went out of under contract, only less than 900 of them closed. Same thing is probably going to be true for the next month. New constructions for sale did go down by 20 homes, but remember, we have a lot of withdrawns, terminated, and that means we're still having builders putting houses on the market since we lost over 200 of them due to expired, terminated, withdrawns, short sales, builders going out of business, all that stuff. Look at the average time on market, up 12%, 101 days. I'm going to break that down in a further one, but this is where we made one of those top 10 in the countries. Median asking price actually went up 2%. Median selling price went up to 4%. Those are positive things, but again, I think that number is a little overinflated due to all the $1 million homes that sold, and the percent of asking price to sold price tells you that when people do go under contract and close, they're probably at the price they need to be to get it sold, even with these picky buyers and this lack of demand. So first thing I want to talk about, Cape Coral. Now, when it says Cape Coral, it also means Cape Coral, Fort Myers. All right, it's mostly about Lee County. Look at this graph. You think this is the top 10 in Florida? No, this is the top 10 days on market in the country. The longer things take to sell, it kind of tells you a little bit of, it's a leading indicator about how the market's doing. Number 6 in the country is Cape Coral, Fort Myers, and you can notice here I highlighted every one of these top 10. If it takes that long to sell a home, is that area going down? Is the home value growth dropping? And you can see here, absolutely, positively, yes. As a matter of fact, only 2 areas have double-digit home value growth year over year, and that is Punta Gorda, Port Charlotte, our neighbor to the north, and Cape Coral, Fort Myers. So 100 days on market, that is a crisis. When it's under 30 days, means things are selling quickly and it's got high demand. High days on market up to 90, this means slower buyer activity, overpricing, and a shifting of market conditions. But when you hit over 100 days, being that there's only, 8 places in the whole country that even went over 100 days, and we were in that top 6. That's a crisis mode. So this is one of the things that isn't a positive swing, but if you think about this, negative home value growth and multiple and 100-day plus on the market just means this is really a top 10 list where buyers have the most negotiating power, isn't it? So that's how I look at it. Anyway, moving on. Pending home sales, you can see here the COVID lows, and this is right at the outbreak of COVID when people didn't want to leave their house. That is pending home sales at its lowest, and you can go all the way back to 01. It never hit that low, and you can see here we are just hovering right around the 75 mark. This is something that comes out of NAR, and this just tells you that the buyers have absolutely disappeared. But one piece of data, the applications for mortgages did have a significant increase. So what does that mean? That means more people inquired about getting a mortgage, but didn't get a home. And now you might understand why. We're going to break that down to a little bit too. But then thanks NAR for always having good data that helps explain maybe why we have bad sales and bad demand. This is in the country. NAR also came out with the record low home buyer demand, and we're going all the way back to 1999. Look at the lowest that we ever had, 2009. Makes sense. Had a big financial crisis, had the housing bubble, everything was at its all-time lows. We had foreclosures galore, and that was that. But here's one thing. We are just slightly above that. Second lowest since 1999 as far as home buyer demand. But here's another thing. Our population is 20% more than it was back then. So shouldn't we have more buyer demand anyway, because there's more people trying to buy homes or more people that live in the country? So this is nationwide. So regardless of where you are in the country and you want to buy, I will offer this much. You need to have agents that have experience in when this happened, like someone with 25 years experience like me. And I don't care if you're in another state, another metro, or anywhere else, or maybe even the top 10 most negotiating power cities I just flashed you. You wait, I can find you somebody like me that isn't afraid of making an offer, who isn't afraid to go under where it needs to be, and to protect you as a buyer. And for you sellers out there, we all talk about some ideas that I have that I've been successful with. Matter of fact, I just sold in a community where there's 40 active houses and no sales. For 6 months, I was the very first pending sale, and it closed. And I had 10 agents call me and ask me, what did you do? It's marketing. So either way, this isn't a good sign, guys, that we not only are ranking in days on market, but that we have in the country record low home buyer demand. And it makes you question why. Well, first and foremost, prices are dropping because builders have the most inventory, not the most they've ever had. But look at this graph, guys. This is single family new constructions in the South Census region. Anything that's considered South is on this list. And look at how many homes these builders have. 295,000, even though it went down from its peak a couple months ago. That's more than we ever had in the financial crisis when we way overbuilt and we had way too much inventory. So this is what's going to happen is the builders are the most distressed. They have the most inventory and they have the biggest pockets. So as they start crashing the market and they're giving the most incentives, and we're going to show some of those incentives, and they have the most they've ever had since 2006, it's going to make the used market get further and further disconnected from the actual market itself. So I thought this was a very interesting graph. Where do I think the market should be? How many houses should builders have? That's why I kind of highlighted the 160. Looks like a good trend that it kind of hits, exceeds a little bit, goes under, goes over, goes under, kind of peaks out a little bit, and then you have this big boom, and then you have an even bigger boom where they have a ton of inventory to sell. Another stat that came out, this is the 5 big cities, that's a population over 100,000 people, according to the Zillow Home Value Index, which is ZHVI, with the biggest price declines since peak. And when did we hit our peak? 2022. When did most cities hit their peak, except for Phoenix? 2022. And look at how much our prices have gone down. 20% from peak. That ranks us the number 3. Cape Coral Fort Myers makes us the number 3 biggest decline in home value according to the Zillow Home Value Index. I thought that was interesting, but when you break it down even further, Cape Coral Fort Myers leads the country in year-over-year decreases, which means at 10.6%. That I'm not talking, we didn't lose all that in 2022 or 2023 or 2020. 1 year from here, we lost 10% of that. Half of that decrease happened in the last 12 months. And that makes us number 1, with Oakland being in second place at 10.2. But something that I thought was interesting, when I found this on Wolf Street, this is the first time I actually saw someone put in a graph housing bubble. Housing bubble 1 makes sense, right? This big peak and this big drop off. And look at housing bubble 2. And this is kind of where our peak was in 2022. This exploded from 2020 to mid-2022 when we actually hit our peak. Our prices went up 76%. Does that sound right? Does that sound like what happens in real estate? Doesn't real estate go up 3 to 4 or 5% along with income? Did income go up? Not a dime during that time. That was just all speculation, FOMO buying at its finest. And as you have big steeps up, you tend to have equal big steeps back down. National Home Builders Association, that is all the foot traffic. They put out this. I went over this a couple months ago. Just want to keep you putting this all together. That potential foot traffic to builder models. If you're above 50, means it's got nice foot traffic. At 50, a balanced amount of people coming in. When you are below 30, as you can see, it happened ever since we hit our peak in 2020 and mid-2022 when we kind of got to that level. We have not seen any foot traffic going into these models, and yet they have the second most inventory they've ever had, with the most being just a couple months ago. So that may have, putting all this together, you're kind of getting an idea. I put 2 graphs together. Why are buyers inquiring about mortgages but not buying homes? And I have some insight here. Fred came out with what is called the revolving consumer credit owned and I can't say the word securitized debt. This is credit card debt. Revolving lines of credit are credit card debt. And look what happened since 1970 in the country. How much millions of dollars, and just so you know, a million is $1 trillion. Right now, we have a record number, $1.3 trillion of people worth of debt is owned by people out there in credit cards. Then you couple that with the same time with credit card delinquencies, which are at the highest level since 2011 with over 12%. Well, what does that tell you? People are over leveraged. They have way too much debt, thus making it not affordable for them because they have too much credit card debt and revolving lines of credit debt. And 12% are 90 days late. To be considered delinquent, you have to miss 3 payments, not just 1 payment. 90 days plus late, you are now that. When you couple these things together, you got people with bad credit and you got people that can't afford homes. And so this is maybe why people inquire and then they realize they can't qualify for a home. That might make sense of why applications uptick and pending sales remain stagnant. So let's just overview this real quick. End of October, we had an increase of inventory as we expected, as it's going to be next month and the month after that until we hit our peak in January, and then it's just going back down again. We'll have to see if this season is actually good or not. Pending sales went up 3%. Sales increased 5%. That's good news. Median home price increased a bit. Affordability got a little better, but still over 30%. We want to target 21% of gross income going to a mortgage. Stability has increased slightly, but still losing 0.93% a month is still like 11-12% a year. Fed rate dropped again, and yet interest rates did exactly what happened last 3 times. They went up. New construction's running the show right now, and standing builder inventory is still at record-breaking highs, especially in the southern states. As well as a graph that I do, but builder sentiment is really at its all-time low as well. And the builder sentiment means how promising are builders even in the market right now, and they're not. I want to show you this month's deal just to kind of put all this together and say, what kind of deal are you getting right now in this market, with this crashing market, this bubble, this builder's panic? Look at this house right here. This is the house we got literally a couple days ago. Brand new construction, 1828 square foot, 4-bedroom, 2-bath, 2025 built, brand new home. Showing here, $387,990. Did I sell the same home about 4 years ago for $450? Used home, by the way. But $387 for a brand new home looks like a great deal because they took 20 grand off. It was at $407. So this is the deal we kind of did. I talked to the higher ups, and what you find is that they have a dollar amount that they can give, a margin hit. Hey, we got 91 grand to play with. And I figure out what's the best for my client, best for my buyer. What does that mean? The less out of pocket, the better, because you keep all your cash, and the lowest monthly payment you can get, which is by interest rate buy down. So look at the deal we structured. We went to them with a 13 grand off, a 4.99% 30-year fix, not an ARM, but a 30-year fixed mortgage. That cost 7 points, or $26,000 to make that. 6% concessions, which is $22,500 in closing costs, which we use to pay all the prepays, all the insurance forward, all the escrow, everything, 2 months of no mortgage payment, and all the closing costs, taxes, doc stamp tax, you name it, all the closing costs you have, that buyer, the builder is paying all of it. And then there's about 7-8 grand left over to make that 4.99, 4.5. The lowest you could actually positively go where a bank would still do a deal. Then I asked them to pay off all the utilities. The utilities are when an area is on well and septic, and they get city water sewer. There was an assessment of about 20 to 30 grand. In this case, it was $25,800. Pay all that off, and then to even boot, I want 1 more percent because I knew they had 91 grand to get that. I asked for a credit for flooring so they can change the floor because they hated the floor that the builder was giving them. So they're going to get a new floor. This deal ended up being for a $387,990 house, 13 grand down. This is all my buyers going to have to put out of pocket. That's their 3.5% down FHA, and they brought the mortgage payment to $24.25 with a 4.5% 30-year fixed mortgage. If this house was used, 1 day old, 1 year old, 2 years old, doesn't matter, and we asked for the 6% concessions towards closing costs, which a lot of sellers are giving, and making the down payment the same, that payment will be $28.40 with today's interest rates. That's saving $415 a month for a new home versus a used home. And that's the equivalent on a used home of taking 83 grand off the price, which means that this house really should be 300 grand if it's used, because the new houses at 387 are the same monthly payment like it's 300. Do you see where the deals can be had this year, even though it looks like I'll just sit back and wait? You can make your deal happen and get 90 grand. My kind of thing is an okay deal, 20, 30 grand off. A good deal, 50 grand off. Great deal, getting close to $90,000 to $100,000 off. So that was this actual deal that happened a couple days ago with my clients. So my advice for buyers is patience, 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 patience. Market of falling daggers. Why did we get that deal? Because it's the end of the month. Because The month is ending and they want that ding, they want that sale. You kind of pick your payment and you say, I want to be under this, and we find the perfect home, brand new home in this case, and we get it for you. You do not settle in the it'll do's and even if you said, I love the home, but I hate the floor, I hate the paint, I hate the appliances, and we just ask them to do it even though they say they can't, they will find a way. Builders have way too much inventory in the books, and home prices, most people believe, are 17 to 18% overvalued. I say instead of waiting for the prices to get down to 300 from 387, you just make the deal happen like it did that already. That's one way that you can stay ahead of this market. And for sellers out there, I will say this. We still have that fake equity. It is getting better, but we are still way over where the house prices ever should be. But to sell a home in this market, you're competing with builders. You want to get a pre-inspection to show buyers that they do not need to make repairs. Get the inspection, they tell you what's wrong with it, you fix those items. You offer concessions and buy downs and do the same thing these builders are doing. Not 100 grand or 90 grand. You can't even give more than 6%. But every dollar matters right now. This is why buyers are struggling. They want to buy your home. They can't afford it. It's not your fault. It's not their fault. It's market conditions. But you do have to market your home differently than the competition, because we got close to 11,000 homes for sale. How are you going to set yourself apart? It's not price. It's marketing. It's the pictures. It's the descriptions. It's the questionable things. It's the book an open house and then cancel it. Build up that momentum. You know how many calls I get to say, why'd you cancel it? I did it so I can get the phone call so I can convince them to go back in as a private tour. These kind of things are tricks that work in this market, because I've been in this market when we did crash last time. Data, I highlight there. Feel free to pause it. Where I get all my data, it's all out there. It's all national, which goes to say, no matter what metro city you're in, I can find me in almost any agent that I will interview 10 of them to find the one that I would use if I was moving to Boise, Idaho, or someplace in North Dakota. I can find those people so you don't have to roll the dice and take your chances that you're going to get someone with less than 5 years experience, because the average agent, less than 5 years experience. And then, of course, you ever need anything, you can call me. This is my cell phone. That is my email. And you can always check all these market updates and videos at LeeCountyMarketUpdate.com. I look forward to hearing from all of you. Thank you for watching. Talk to you later.